I'm sitting with Chris Heakes, Senior Portfolio Manager with Harvest ETFs. Welcome, Chris.
Thank you, Simon. Great to be here.
Wonderful. Could you please introduce yourself?
Well, for sure. I guess I'm an ETF veteran now. I've been in the ETF industry for 15 years as a portfolio manager, and have joined Harvest ETFs to start this year, 2025. But have been managing ETFs for 15 years, and across equities, covered calls, and a bunch of different strategies, being active in the industry.
Where do you see markets right now?
Yeah, I mean, the only certainty is uncertainty. It feels like with the markets right now. There's an interesting metric we look at, global trade policy uncertainty. It's an index you can actually track, and, it's tended to be pretty stable. In Trump's first term, we saw some spikes to that index. Things stabilized down under Biden, and what we've seen with Trump's second term is a tremendous spike to the upside. And I think, we're all, can see it on the news, but tariff policy, geopolitics are certainly very volatile right now. So we're dealing with a lot of volatility in the market. That being said, as equity investors, we have to remember the equity market, deals with volatility all the time, and there are many crises over the years, but, dealing with a very uncertain market. So, it's a time for investors to be thoughtful about how they're approaching the market, how they're diversifying, and how they're mitigating risks in their portfolio.
Do you think that there's one aspect, like you mentioned a few, geopolitics, monetary policy, as well as just economic policy coming out of the White House? Do you think that there's anything that is kind of playing the biggest factor?
Yeah, I think probably geopolitics is the biggest wild card on a short-term basis. But in terms of kind of maybe most lasting policy, I think this trade policy, the tariffs have a major impact, because how does a business manage itself when policy is changing from one day to the next? And that's really what we've seen. So it's a very difficult environment for businesses, which makes it a difficult environment for investors. I do think ultimately, we're in a period of disequilibrium. A period of disequilibrium will tend to lead, the pendulum will swing back to, a period of a more steady state. So that'll tend to happen over time. But I think probably just the amount of disruption is probably the most kind of unique, risk that I've seen in the market, in the last, probably since COVID.
And there's something else that kind of is behind the scenes in markets. What I find is that it's very tempting to try to generalize that this problem or the market is acting every day. And so we're trying to say, why is the market acting the way it is? This is a funny week. We have something called triple witching. There's an options expiry that's happening at the end of this week. Could you talk a bit about how these things affect broader markets?
Yeah, for sure. So, it's kind of where the rubber meets the road, I guess. These are higher concepts like, what are the macro events happening in the world? What are the fiscal policies, the monetary policies? And then that's kind of, the macro world. And then, I think what you're talking about, the triple witch, is kind of the micro world. And that's like, what are traders doing on a day-to-day basis? What are different index participants doing? So the triple witch, it's a day of high trading. So you have index ETFs rebalancing, you have option expiries, future expiries. So a lot of moving parts in the markets, and it's typically a period as well where covered call players like ourselves at Harvest are active in perhaps buying back calls that have gone in the money or putting on new positions to generate income.
So you're active in these markets where they're called options markets, right? Could you describe what options are?
Yeah, so equity options, gives there's call options and put options, but let's stick with calls. We're going to focus a conversation on cover calls. So let's just start there maybe. But gives the holder of the call option has the ability to buy a stock if they choose to at a certain price at a certain time. So the price is called the strike price. So let's do an example. Let's say Apple is at $200. A call holder, let's say they have a strike of 205 and it's expiring in 1 month. So if at the end of the month Apple is above 205, well, if you're the call holder, you'd sure want to buy the stock at 205 if it was trading at, say, 210. So that's when the call holder will exercise that, and they'll capture a profit on that call. So that's the buyer of the call. The seller of the call, and this is what's done in the cover call strategy, is we hold Apple as an investment in our portfolio. We sell that potential ability to buy stock to the call holder, in return for which they pay us a premium. So they're going to pay us, let's say, $2 for that ability to buy Apple at 205. So therefore, as a call seller, we've earned a premium. We will earn upside on Apple up to the strike price of 205, but if it goes beyond that, we would forego some upside. So what a cover call strategy is doing at its very essence is it's trading away potential upside in return for more current income. So increases income, which tends to reduce risk and normalize returns, and perhaps forgoes, high upside returns if that's the case.
And so the seller would end up getting extra income and extra money.
Correct.
Yeah. So if you're getting that extra money, what does that do to the overall risk of the portfolio that you're managing?
Yeah, well, extra money is always helpful, as we know. But when you think of that extra income stream, it's something that's going to be consistent month over month if you continue to do it. So that's going to be additive to returns. Now, in the scenario where the stock goes up, as a call seller, I have to sell stock at the strike price. So it could forego some of the upside if the stock really rallies. And we can get into the dynamics of how it's really a trade-off between growth and income. So cover call strategies will get more income at the expense generally of a little bit less growth.
What it does is it reduces the risk of the overall portfolio.
Right.
All right.
Yeah.
When it comes down to it, what are the things that affect the amount of premium that you're getting?
Yeah, so there's a few things that affect the premium. One is how far that strike level is from the current price. So that can impact it. Like if Apple's trading at $200, what's the possibility it would be $300 or more in a month? Probably very low. So an option of that nature would have very little value. So where the strike is will be a determinant. How long the time horizon is will also be a factor. If you have more time for Apple to go in the money, then that increases the value. But the thing that's probably the most interesting and kind of compelling about cover calls is volatility. And what volatility is, it's a measure of how disperse a stock's potential outcomes could be. So a low risk stock will tend to not move too much. A higher risk stock will tend to move more. And what that means for cover calls is when you have more volatility, more range of outcomes, it means more premium collected. So, volatility, it's a bit of a four-letter word when you come to equities. Usually when you're talking about equities and volatility, it's not really a great thing, at least in the short term. But the nice thing about cover calls is that the higher volatility can actually translate into higher premiums. And so especially when you're in markets that are uncertain and there's a lot of volatility in the background, it can make the cover call even more kind of effective to generate income and offset some of that volatility that's in the market.
So one of the things that I'm seeing is that there's a lot more premium inside of the calls, and so that's actually something, this volatility is making the strategy more attractive today than it was perhaps even a year ago or especially 5 years ago.
Yeah.
Are you finding that those call premiums are bigger now than they were pre-COVID?
Absolutely they are. Yeah, absolutely they are. Like, I think when we were in a 0% interest rate, environment kind of coming out of the financial crisis, rates were low, equities were generally doing pretty good, some periods of volatility, sporadically, but in general, kind of an easier environment in terms of equities, a lot less volatility. The cover call strategy can just still deliver added income. But I think what we're seeing now is, well, look, interest rates have gone up. That's created volatility. Fiscal policies are more uncertain. Geopolitics is more uncertain. So this whole backdrop we're in has created more volatility, and it's measurable. the VIX index, some of your listeners are probably familiar, but that measures the volatility of the S&P 500 as an overall. It looks at option prices and reverses out, actually. It says, okay, this is what the price is. It reverses out and says, well, this is what the volatility must be. And the VIX has increased over the past 12 months, probably not surprisingly, right? And so definitely it translates to higher premiums and, really gives a covered call, seller like ourselves, that ability to add extra income and make that an additive part of a strategy in a volatile market.
So when you're writing calls on your portfolio, do you write them at the money? Do you write them out of the money? And how long do you like to use them in order to generate income?
Yeah, so that depends. And, here's where you get into the kind of the devil meeting the details. There's different approaches out there in the market. Some are highly systematic, highly rules-based. Some are more active in nature. And generally, I'd say Harvest, we're a little more active in nature. Some of the rules we do have, first and maybe most importantly, we only cover up to, generally speaking, 33% of a portfolio. Some mandates will go up to 50%, but generally 33, and the reason we do that is we're covering 33%, well, that portion of that portfolio is going to earn income, but it's going to forego some upside, potentially if stocks go up a lot. But that means we've got 2/3 at least of the portfolio that's going to have the full upside. Now, the other area where, so that's important, we want to make sure there's growth as well as income. We think, if we're investing in equities, we want growth as well as income. And then, in terms of the active approach of Harvest Nature, it's not just 33% across the board. So maybe some scenarios would be helpful. So let's say the market's very volatile. Let's say when Trump did his Liberation Day in early April, volatility skyrocketed. For us to deliver our, let's call it an 8%, 9%, 10% distribution yield, which would be kind of indicative of many of our ETFs, we wouldn't have to do 33% in many cases. We might do 25, we might do 20, maybe even 15. So we're going to take what the defense gives us, so to speak. Furthermore, we're going to look at each name in our portfolio. Maybe some names have experienced more downside than others. Maybe the option dynamics on a name, we want to play a bounce back in a name, so we'll go a little lighter on the call with that name. Maybe a little further out of the money, or maybe we don't even do calls on that name. Or maybe there's a name that we think, hey, it's, kind of top end of the valuation. Let's say Microsoft, great stock. It's rallied back to $470 here as we're kind of taping this. This is, 30 multiple on it. Love the stock. Maybe that's a good place to sell more calls. So, we'll be more active. And, I think that's really beneficial as too, because, the market's very unique, and it presents different opportunities in different places. And, we want to take advantage of that.
So basically, if something is sold off, you might not necessarily want to cap the upside. You might want to let that run. You find something else that already has run, and then you write the calls on those.
Yeah, exactly. When there's a big sell-off, a lot of times, markets are very emotional, as you know, and investing is a very emotional kind of activity, and sometimes those emotions, get a little overworked in the short term, and that's what we see with stocks. A lot of time, very high quality stocks, they'll still sell off like they're kind of a piece of garbage at the moment, but they're not, and we know they're not, and they'll recover over time. So we want to be careful with that, right? We want to play the upside and manage it that way. One nice thing, kind of an arrow in our quiver, so to speak, is, when you do have sell-offs, volatility tends to increase. That's a general kind of, relationship. So stock sells off, volatility increases. And what that means for us in our approach, we can be active and say, well, we're going to just cover just a little bit of it. But because volatility increases, we're going to earn extra income. So those are kind of some of the dynamics. But yeah, for sure, we want to be be dynamic, and as stocks bounce back, they hit difficulties, they bounce back time and again. We want to make sure we're getting as much upside as we can when we're managing that overlay.
And one of the things that used to be a big criticism for covered call portfolios is that giving up of the upside. And a lot of people would say, oh, I don't want to give up the upside. Mm-hmm. One of the solutions that your firm has is using a bit of leverage inside of some of the portfolios. Could you discuss that just a bit?
Yeah, so one thing we've launched in 2025 is single stock ETFs. And in that case, most of them are using 25% leverage. Also on our traditional funds like HHLs, our healthcare, we've got a leverage version. We do that across our suite selectively. You know, HDIF is a diversified strategy that uses 25% leverage. But exactly to your point, when you think about covered calls, you know, in its essence, it's a deleveraging strategy, meaning it's taking some risk off the table. And the way I think about that is if you're foregoing a little bit of upside if markets are rallying, that means you're making lower highs, all things being equal, but then because you're collecting income, you're making higher lows. So when the stocks sell off, you've collected income, so you're a little better off. So as a strategy as a whole is lower risk versus equities. It's making lower highs but higher lows, so it's a more moderated return stream. We can get back that upside exposure in some, you know, by using, you know, a light amount of leverage. 25% we think is, you know, leverage is always, you know, you have to consider whether it makes sense, right, as any investment, but a little bit of leverage can get back some of that upside exposure and therefore can magnify the income we generate, but can also get back the growth exposure and provide more upside as well.
And some of the single stock ETFs that you have as well, so you're doing the options on portfolios as well as individual companies.
Yeah, and it's been a major interest in the Canadian market. And there, you know, the one thing we haven't touched on is the tax efficiency of options. So, you know, why don't we spend a moment on that? I mean, if you look at dividend income in the U.S., what's coming into scope of potential new regulatory higher withholding tax rates? That's something Trump is proposing. Dividend income, when you're sourcing it outside of Canada, goes onto, you know, as you know, the income side of the tax in Canada. Cover call premiums, there's no withholding tax, and they go on the capital gain account. So it's a very tax efficient exposure. Many of the stocks we brought out on the single stock side, you know, have higher volatilities, which means they're generating a lot of yields. It's structured as a Canadian trust, which is important for some investors as they're being mindful of, you know, how much U.S. property do they have versus Canadian property. Well, that's one nice thing too. These ETFs are structured as Canadian property, and that can have some advantages for high net worth clients. But yeah, we're finding a tremendous amount of interest. One thing I'd add as well is in the U.S., you have a lot of option buyers these days. A lot of option activity has really accelerated since COVID. And we're selling options. The more buyers, the better for us. And so that's part of the reason why we're having higher yields as well on those products.
What are some of the biggest myths about covered call strategies that you think would be good to debunk?
You know, one issue that we come across is return of capital. So when you think about taxation of covered calls, you know, at the end of the year, like any fund, a fund will declare over the course of the previous year what percentage of its distribution was, say, dividend income, what was cap gain, and what was return of capital. You know, with covered calls, you can see a higher amount of return of capital. So there's this myth that the covered call provider is just giving me back my money. But maybe I can walk through why there's return of capital in a covered call, and it does depend. Now there are some actors are better than others in any industry. Some companies will over distribute, you know, and then that will naturally result in a return of capital. That's not Harvest's philosophy. Our philosophy is to earn out what we're distributing. But when we're selling call options, basically one of two things can happen. So we're going to sell call options. Let's use Apple again. Month after month, we're going to sell call options on Apple. Now, if Apple just flatlines for the year, so it doesn't rally in any month, as a seller, we'll collect that option premium. It'll expire worthless every time. And in that case, we're going to have a capital gain. All those premiums will add up to one good-sized capital gain by the end of the year. And that's a good scenario. We want the gains. But the other reason and how that can turn into ROC is Apple, as it generally has done, you know, has been rallying. And so if we'll sell an option, let's say we sell it for $2, but Apple rallies and we have to buy it back for $5. We sold for $2, bought for $5. That's a $3 capital loss. And so that capital loss will offset other gains in the portfolio, and that creates ROC. But again, it's important to differentiate ROC that's just a tax consequence of what's happening versus just simply over distributing. So maybe that's one myth. And I hope I didn't go too deep into the tax rabbit hole there, but you know, one myth of, you know, why you can legitimately have ROC in a covered call strategy.
I think it's really interesting, and thank you very much for bringing that up, because there's the managing of the portfolio creates gains, there's dividends, there's losses, there's income. But then at the same time, you're managing a portfolio of options, which also gives gains and losses. And the way that options work, like you're saying, is that that there's the opportunity to kind of choose: do you want the gain, do you want the loss? And I would presume that that would make the strategy much more tax efficient.
Yeah, absolutely, because we're earning this option premium. If it becomes ROC, that's essentially tax deferral into a further period.
So at this point in time, in my opinion, and I would presume yours as well, is that covered calls are actually extremely attractive at this point because of the volatility. Is there anything that might affect that attractiveness when you're looking out 6 months, 12 months from now? What would you be looking at to determine whether or not this is still a fabulous strategy?
Yeah, well, I think that the number one thing to look at with a covered call is the underlying, right? So is it, say, a broad U.S. strategy, like our fund-to-fund, like HRIF, right? That's a broad strategy, predominantly U.S. Or let's say technology, HTA is an ETF. But you're going to look at what's going to be my outcome on my covered call ETF. Well, number one is going to be what's the underlying doing, what's technology doing, what's the U.S. market doing. And obviously just being mindful of having that plan, and that's obviously the value of the financial advisor, just setting that plan and sticking to that plan and having that discipline and being aware. That's number one. But other things, covered calls, they've tended to lag the last 10 years, right? 10 years on the S&P 500 has been very, very strong. Now that being said, when you do it the right way, you still participate a lot in growth, but it still lagged a bit. But the question is not what did the last 10 years do? The question is what's the next 10 years doing? And I'm not saying, because the last 10 years was great, the next 10 years is bad, but generally speaking, maybe it won't be 10, 12% a year, maybe it'll be 6 to 8% a year. And in that scenario, more moderated, covered calls can really add value. And so that's what we're seeing. We're coming off 2 years of 30% returns in the S&P 500. You typically don't get a three-peat. Not to say it's going to be terrible, but you typically don't get a three-peat on 30%. And so it's a more moderated return profile. Again, with higher volatility, can be pretty additive. And again, the real downside, and this is why I like covered calls as well. Your downside in covered calls is if the market really rips. And so guess what? If the market really rips, let's all try to be pretty happy about that, because that's a good outcome, across the board. So whether you're up, market's up 20 and you're up 18, I still think that's a great outcome, especially when you're being mindful of the downside risks as well. So, that's just another reason why I think it's a really great strategy.
Thank you very much for joining me today. If somebody wanted to find out more about you, the work that you do, and Harvest, where would they look?
Yeah, for sure. So I'd say just go straight to our website at harvestportfolios.com. You'll see a listing of our ETFs. You'll see our single stock ETFs are on a companion site that can be accessed there. And focus you to the Insights blog. There'll be some blogs from myself, some better writers as well, delivering timely insights. You can subscribe to that, get a monthly update from our CIO, quick 5-minute video talking about themes in the market. But check out that Insights column on our website.
All right, that's fabulous. Thanks very much, Chris.
Thanks, Simon.